With in the Middle East and Eastern Europe and an upcoming presidential election in the United States, there's a great deal of uncertainty in the markets concerning the future of energy and ways to invest. To answer some of those questions for us, we have the honor of being joined today by Paul Sankey of Sankey Research. Paul's got extensive experience in being an oil and gas equity analyst. After leaving Manchester University, he joined the International Energy Agency in the early 1990s, just around the time of the first Gulf War. And then following that, he spent several years with Deutsche Bank and other institutions on Wall Street, really over a period of greater than 30 years, really studying energy and advising decision makers on proper energy investments. So as I mentioned today, we've got the honor of having Paul with us here. Paul, welcome to the program.
Hi.
What I wanted to do was start out basically with kind of an overview of energy in general. When it comes to oil and gas and even other forms, where do you see energy going in the next, we'll say the next 2 to 3 years? And, what are ways that people can position themselves, investors can position themselves in those markets?
Sure. I think I'll just give you a couple of bits of background about my experience and, how I look at this. And, in military terms, they say that amateurs talk tactics and experts talk logistics. And I think a lot of what you hear in energy is people talking tactics. You know what I mean? They come in and they're like, let's just turn everything to solar or, whatever it is. But the real logistics of transitioning the energy economy are just much more enormous than you can possibly imagine. And, I think people are realizing now that things like solar and wind are intermittent, so they don't run all the time. They don't run at times when we need them. And the biggest theme at the moment, which takes me back to your question, is the whole issue of AI and the amount of energy AI is going to demand. So that's really the thing that's exciting the market right now. I think in order to become not an amateur talking tactics, but an expert talking logistics in energy, that I always say there's only one barrier of entry to being an oil analyst, and that's units. And when I say that, what I mean is, do you know how much energy you consume a day? Do you know how much energy you consume a year? Do you know how much the US consumes? Do you know how much the world consumes? These are all things that people just simply don't really know. And you really need to start with a barrel, because everyone can understand a barrel. And a barrel is about the size of exactly what you imagine. Pretty big thing, especially when it's full of oil. And right now, world oil demand is at an all-time record high, 102.5 million barrels a day. So we're shifting 1,200 barrels a second of oil at a cost to buy of about $80 a barrel. So that's just some thoughts on the background. The outlook here is interesting because despite that incredibly high demand number, the 102.5 million barrels a day, which by the way is an all-time record high, globally ever, we're using more oil than ever. And you have to add in at that point, it's mandatory that we're using more coal than ever. So we're at all-time record high levels of coal. And I shouldn't say we, I should say China and India, because we've done a good job of substituting coal, which of course is much more emission intense. What you're looking at today, even with 102.5 million barrels a day of demand, is that we actually have too much oil supply, believe it or not. And there's probably about 2 to 3 million barrels a day of spare capacity. So this, I promise this time, brings me back to answer your question. The outlook at the moment doesn't look that great for oil because there's a lot of indicators, as you're all aware, of the economy slowing down. And oil is essentially the primary driver of the economy, especially transport and logistics. And as a result, the demand outlook is faltering quite badly. At the same time, we're actually adding more supply. There's been an incredible story in Guyana, which I'm sure some of you have heard about, but they've gone from zero to, they are going to 1 million barrels a day of production, believe it or not, with only 600,000 Guyanese. Kind of incredible. They're going to get very rich. And so the supply and demand side is worrying. So people are more excited about the electricity side right now, and the stocks that have been really hot have really been following NVIDIA, because each NVIDIA chip, and they've basically sold 2 million of these things, each one uses the same amount of power as a house. And this is again coming back to units and understanding the intensity of the energy demand you're looking at here. And of course, these things can't run on wind and solar because they need a lot of power constantly without any interruption. And you're talking about a tolerance of well less than a millisecond a year of outage. So there's no way, when there's no sun, you can run a data center, and you can't turn them off and on. You can, by the way, turn off Bitcoin mining and turn that back on, which they do in Texas. But for the data centers, it's going to be a big demand load. So in my space, what that's leading people to is actually wanting to own natural gas, because natural gas in the US has been really remarkable. It has done an incredible job that I would never have anticipated 20 years ago of growing its own oil and gas production. And we're now the biggest oil and gas producer in the world. So there's definitely some willingness to buy the best oil companies here, the Exxons, the biggest gas companies, which would be something like an EQT or an Antero, the best Permian player, which would be like a Diamondback. But generally speaking, there's a concern that we're in an oversupply situation and the stock's not doing that well. And then you're a bit late, I'm afraid, on what we call the IPPs, which is the independent power producers. But something like Vistra in Texas is very much seen as a play on what's likely to be severe power shortages in the US. The power is tough because it's generally a sleepy, regulated and utility business. And investors for the first time are getting interested in these stocks, which historically have been super sleepy. But it's also going to be a problem because with utilities, you're dealing with a sleepy company, a sleepy state regulator, and a sleepy federal, if not sleepy, then incompetent regulator. And it's going to be very hard to add the amount of power that these AI centers need. So if anything, I'm worried that actually the AI boom will not be powered. And you can hear Mark Zuckerberg talking about a bottleneck in electricity supply. So that's an issue. Over the next couple of years, we basically like refining the names I listed in oil and gas, which are the highest quality ones, and a couple of IPPs, something like Vistra is basically where we're at. And I'll just throw in, we always believe that refining is undervalued in the US, and we believe pipelines are undervalued in the US. So we like a Plains All-American or an Enterprise, boring but effective stocks, MLPs that pay a high yield. And the refiners, I just love Valero, Marathon. I'm friends with the management, and they're just outstanding companies. That was a long answer. I apologize.
No, that's good. I will say those are good recommendations. And just for our viewers, we want to obviously caveat this with saying, we're not giving you specific financial advice to buy these, but we are saying that these are good examples of companies that, are good investments.
Yeah, I'm not allowed. I'm an independent researcher, and we're not making any recommendations, believe it or not. I'm saying I like these stocks.
Okay.
I'm making zero recommendation to anyone because everyone's situation is different. And, you really have to do your own due diligence and make sure that what you buy suits you and not me. Yeah.
Yeah. And Paul, the question that I asked and the answer you gave led me to another thought, and that is, you were saying you see a lot more potential in natural gas, right? And do you see that as being bullish, or do you see that as also having weakening demand with oil in the next few years?
It's actually, again, it's a slightly different story. The gas demand story is unbelievable because you're adding all this power generation capacity. The fastest, most effective, most efficient way to add what we call baseload power, which is runs whenever you need it to run, and can run 80 or 90% of the time, as opposed to a solar panel that runs 10, 20, at best 30% of the time, is natural gas combined cycle gas turbines. And you can put one of those up if you're rushing in a year, and it'll generate a ton of electricity with a small footprint and burn a lot of gas, which burns relatively cleanly. So you're expecting a lot of gas additions there. And then the US is becoming, and has become actually, from zero in 2016. We are now the biggest liquid gas exporter in the world, LNG. That's been an unbelievable story. The fact that we've managed to do all that with gas prices still at $3 per MMBTU, around that level right now, you multiply by 6 to get dollars per barrel. So gas here is about $18 a barrel. Oil here is about $80 a barrel. So there's a huge arbitrage, as you can imagine. The fact of the matter is that the demand side for US gas at $18 a barrel, $3 per MMBTU is enormous. And there's huge demand for our LNG exports and huge demand internally for more power fired by natural gas. But again, the supply is unbelievably abundant. And because of that price arbitrage, you're drilling for oil and producing oil, you produce a lot of associated natural gas. And that gas is actually basically negative cost because you get the money from the oil, you get the gas for free. And so actually the problem with natural gas tends to be there's an abundance of supply in the US, believe it or not, because we are producing and consuming staggering amounts. But there it is. So people are buying natural gas more thematically now, probably more on hope that the AI thing does keep going, which I think is too much hope. I'm very skeptical that AI is going to deliver anything more than great crazy graphics, fake deep fakes. And I'm not convinced this thing is. There's a great tweet by a woman who said, I wanted artificial intelligence to do my washing and ironing. I didn't want it to do my art and my writing. And what you've got is, as I showed the other day on my note, a good example of what AI can deliver. And it was a picture of the Rock eating rocks in a hard rock cafe, which is like, great, the world's really advanced with that. So I think it's a lot of hype, quite frankly. But the long-term story for natural gas is very obvious, because as you substitute more oil, use less coal, the exports that we're making are all to substitute coal, essentially, or help with Russian gas and issues there in Europe. And so that what we would call the secular long-term story for natural gas looks great. Whereas, of course, with oil, you're valiantly trying to substitute as much oil as you can, particularly from cars through EVs, which isn't going very well, but you're trying. And you don't use any oil in power generation or in any other thing. So essentially, oil is also used for petrochemicals, and the big demand market is jet fuel, which is booming. But all of those things are essentially under pressure. Whereas with natural gas in the US, the demand story is sort of up and to the right forevermore, as far as the eye can see, because of the potential, for example, to substitute all that coal in India and China I'm talking about. So that's definitely the story with natural gas. And the valuations look okay. The companies are showing good capital discipline, and all these companies are trying not to spend money, trying to make higher returns, and trying to give you back money. So if you are a military veteran, for example, depending on your age, you're probably getting to the age where you want dividend stocks, things that pay you an actual income. And any of these energy stocks fit that bill very well. So they're worth considering in a portfolio where you want high dividend.
A lot of our military and veterans, Paul, they invest in the thrift savings plan, which is the military and federal government retiree version of a 401k. And in there, they don't really have any funds that are dedicated exclusively to energy. Aside from individual companies, are there examples of any energy funds that maybe own a lot of the companies that we see or that you see as good, solid dividend-paying companies? That would be a good way to diversify.
Oof, that's a tough one. If you're talking about individual, funds, as in a natural resource book, you have my friends at BlackRock, you have my friends at Jennison. There's a few specialized natural resource funds, which have their own tickers, but you've sort of got to look them up, and I can't tell you the tickers off the top of my head because they're like 6 letters long. Sure. The XLE is the ETF, the exchange traded fund, which is a basket of oil stocks, which is dominated by Exxon and Chevron. Exxon and Chevron are in the best shape I've seen them in my career. 20 years ago, Chevron was a bit of an embarrassment, and 10 years ago, Exxon was the same. And now these two companies are really, proud American companies that are doing a fantastic job. So those two sort of, especially with Exxon, you kind of capture the whole of the chain in oil, because they produce, refine, and make petrochemicals on an integrated basis. Shell used to, BP used to, Total used to, all these big companies, even a Hess or a Marathon Oil used to, but none of them have retained that integrated model, and particularly a failure on the part of Shell and BP. Exxon is stuck with it. And so you can actually buy Exxon as a sort of a catch-all. You can buy Valero as a catch-all for refining, or Marathon Petroleum. You can buy, as I mentioned, the Enterprise or Plains are both very representative MLPs. And then the gas name that we like is AR and Terra Resources, but a bigger one, which would be representative of the gas theme, is very much EQT, which is the biggest gas producer in the US, or you could do a Chesapeake CHK. Although Chesapeake's about to change its name because it has a bit of a mixed past, shall we say, having been bankrupt and a lot of other things. But those are all, very representative names. The overall ETF is called the XLE, as I mentioned, and then you have the XOP, which is more upstream oriented in theory. So it's less Exxon and more of the smaller guys, more leverage to oil. Those would be the big ones.
When you mentioned XOP being kind of the higher up the upstream, is that more exploration? What exactly part is that? Is that the drilling?
Yeah, you're exactly right. So basically, okay. we have a progression in oil from getting the stuff out of the ground. I mean, this is just a giant engineering business. The CEOs are all engineers. Almost all the top people think there's some sort of politicians in bed with Dick Cheney or the Russian mafia or stuff. In reality, they're all engineers. You look at Exxon, Chevron CEO, Conoco CEO, you name it a CEO, I'll tell you he's an engineer because I've checked and I know them. So the XOP is the upstream, what we call the upstream part of the business, which is finding, developing, and producing the oil. And then you have a midstream, which is moving it, pipelines, a refining segment. Above the upstream, you have the service companies, which historically were considered to be even more levered. So those are companies that provide the services to the upstream companies. The one that people would know would be Schlumberger or Halliburton. Those guys are doing poorly because the industry is actually showing great capital discipline. In the old days, the industry used to spend like drunken sailors on shore leave. And now, because we've pressured them as analysts to stop just spending everything they get because they were paranoid about finding more oil, and they don't need to be anymore because they've kind of found the oil in the Permian. Now they can be much more capital disciplined and generate a higher return, and that's bad news for the service companies. So I forgot to mention we don't like the service companies. And then the XOP is that upstream segment, absolutely. And then finally, at the end, you have gas station companies, which, by the way, are doing great. I forgot to mention that too. A Murphy USA or a Casey's, weirdly, it was always the worst business. But those guys have consolidated the business. And now those mega sites that you see, I'll give you an example. Casey's is the 5th biggest pizza chain in the US, or maybe 4th biggest. It's a major pizza chain in its own right, all through its gas stations. And those are very good income companies as well for retirees, the Casey's, Murphy USA. So that's your chain of oil and gas, kind of the way we look at it. And then utilities are separate. That's really not traditionally covered by an analyst like me. But because we're essentially electrifying the world, and I didn't make enough money to retire, I have to start covering utilities a lot more in the AI age. So here I go.
When you mentioned utilities and AI and where they play in with, energy.
Yep.
In what areas do you think energy is going to have the most impact, or where do you think AI and utilities in the future are going to consume the most energy?
Well, one of the world's biggest consumers of technology is the oil industry. So what you're finding is they're finding a lot of oil, and they're talking about AI. Oil offshore. They're talking about oil offshore in Namibia that's been found with AI because they're processing vast amounts of data as they drill. And the drills, they're not those guys that you used to see sort of doing all this stuff and getting killed all the time. These rigs are now fully automated. Wow. And they use an enormous amount of data processing to direction it. They'll take the drill down 14,000 feet. They'll go 2 miles, and they'll get to within a foot of where they want to be underground in a day and a half. I mean, it's mind blowing. For AI, I think the way I describe AI is it's an answer in search of a question. I didn't ask for a picture of The Rock eating rocks in the Hard Rock Cafe. You know what I mean? It's like, okay, right. Great. I've got a fake Donald Trump on my screen. It's like, well, what could I want that? You know what I mean? It's right. So I think they're stunned that this thing can talk English so well. It does. I mean, I identify as a writer, and I'm a very fussy reader. I can't stand bad writing, and I find the AI responses are absolutely incredible, right? I mean, they can summarize my notes like nothing I've ever seen. But the amount of data processing that, now all my Facebook is offering me AI searches and stuff, I'm like, why? I don't need to. And the amount of data that's used, and that's power, right? Because these are all just billions and trillions of switches, and you're just flicking electricity to an absolutely extraordinary degree. And if your listeners are readers, you need to read Chip War, which explains, it's a book obviously that explains where we are with chips, because it's kind of mind blowing when you think about what these chips do. You know, I think one of the old lines, this is an old line, is that there's more processing power in your iPhone than there was in Apollo 13, right? Or whatever, even, you know, a relatively late moon mission. So, you know, it's just mind blowing. My argument is we've kind of run out of places to go with this, and we've ended up with the rock stuff. So, you know, amongst other ones that are obvious would be pharmaceuticals, you know, new drugs, new drug development. There are a couple of other industries that are very data intense that will, you know, presumably benefit. And I think you are seeing medical. I do think the medical field is, you know, my son just had his torn labrum mended with a, you know, just a keyhole surgery, and, you know, you walk in, you walk out in a day. It's staggering.
Oh, good for him.
People forget, you know, just where we've got to medically, and that will all benefit. My app for Mount Sinai Hospital is phenomenal. It works brilliantly, and I think tells me I should do more steps and, you know, all sorts of things, and go and see the doctor today. So it's a really crazy new area. And what we do know about it is that essentially they're selling the chips before they know what they're going to do with them, and before they have the electricity. And obviously, you know, utilities historically have been sleepy and regulated and the most boring sector in the market, because you just took a 3 or 4% yield from them. You know, who wanted that? You know, nobody ever, you know, got super rich trading utilities. But today, people are, you know, now that if you look at the chart of something like a Vistra, which is, you know, or a NextEra, which is formerly Florida Light and Power, you'll see these stocks have been on absolute tears at times. And that's just because the market gets way ahead of these things and predicts what's going to happen next, which should be very volatile and high power prices. So the way people play it is they buy IPPs, which is the independent power producers, who have more leverage to price variations, because you're going to see crazy prices at times. Because electricity, as you know, is interesting. It has to be supplied and available at the moment you hit the light switch. And if you fail to do that, actually the system kind of collapses. And so real-time pricing for electricity can go absolutely berserk as people try and price out the market. And as a result, IPPs are expected to make enormous profits as we go into this era of very tight electricity markets. The backdrop there is that US electricity demand didn't grow for 20 years. And that was basically because, without knowing it, Americans got a lot more efficient. And that was just buying better refrigerators, LED lights, any number of things that you can think of around your house where people's personal electricity consumption fell. And we also deindustrialized, which a lot of people know, so that, you know, all the power demand went to China. And so these utilities haven't had to deal with big power demand growth for 20 years. And now suddenly they do. And I'm not sure they know how to do it, quite frankly. But the better ones will, and the best ones will do very well. And that's why you play power as a derivative of AI.
Is there going to be, in your view, Paul, is there going to be difficulty for a lot of these utilities to grow their service if they are regulated? Or are there ways that they've been able to, you know, adapt and get around those regulations in a constructive way?
It's going to be a mess. It's going to be very state by state, because there's essentially 6 or 7 regional markets. For example, Texas is easy because Texas is one power market in its own right. And frankly, it should be. I mean, Texas is just about the 10th biggest. It is the 10th biggest economy in the world. I mean, people underestimate just how big these US economies are. And Texas is its own thing. The Northeast, you know, you kind of go around, and it really depends on the regulators. Texas, as you know, is lightly regulated, lightly taxed, and people are flying there to do Bitcoin mining and data centers. And you'll find, you know, certain states. The crazy thing about the data centers and AI is that the investment cycle is 2 to 4 years for a data center. So basically, you build one, and in 4 years, it's obsolete, believe it or not. And so what they do is they move around very much, because, you know, if the power price goes up in Virginia, which is the world's biggest data center, which is very related to the military. Virginia is the world's biggest data center. I think they estimate 98% of emails go through Virginia at some point.
Wow.
Yeah, and the power demand forecast has been quintupled, multiplied by 5 for how much power demand they anticipate for Dominion in the local region. Yeah, I'm not messing around here, man. I'm talking big numbers.
Yeah.
So it's going to be very specific to the regional market and whether the regional market can keep its prices low. And it's a nightmarish combination because Virginia, the county, Loudoun County, where you have all the data centers, is the richest per capita county in the United States. And the first thing you get with rich people is they become environmentalists. I always say environmentalism is a luxury. You try to, if you ask a homeless guy what he thinks of the environment, he's going to tell you to go and sling your hook. But of course, as soon as people get wealthy, they all become bleeding heart liberals and major environmentalists. And so you're not going to be able to build stuff in a lot of these places. I'm actually in the Hamptons right now, and they're trying to build an offshore wind project here. And when I saw they were doing that, I was like, you realize you're trying to bring the offshore wind project ashore, a transmission line ashore through Wainscott here in these Hamptons. Wainscott, it's $10 million an acre. It's where Martha Stewart lives. It's where Steven Spielberg lives. They don't want to. By the way, you don't want to live by a power cable. By the way, they give you cancer. I'm not kidding. I mean, they generate a lot of radiation, right? You really don't want to live near any of those things. So there's going to be a big problem, and everyone agrees, especially with more solar and wind, that you need more transmission. But I'm telling you, if someone wants to build a transmission line next to your house, fight them, because it's not a good thing to have. And so there's a really visible train wreck here, which is what we're saying. We're saying this could be a train wreck.
Right.
Mark Zuckerberg on this podcast the other day, not this podcast, but a podcast the other day, was saying, we're getting to the point where we need a nuclear plant, 1,000 megawatt nuclear plant, which is a good sized nuclear plant. None of them are small. 1,000 megs is huge for any power plant, but for a nuclear, it's about average. They want to build one just to feed a data center. Yeah. And so in the interview, the guy said, I thought Google already did that. And he's like, well, I don't talk about Google. But in reality, Amazon has already taken a 900 megawatt power plant nuke, and that's just going to feed their data center. So it gives you an idea of what a mega theme this could be, especially if AI actually starts to deliver stuff. If we really do start to adopt a lot of this stuff, which I'm very skeptical about, but believe me, I've been wrong many, many times before. But when you think about not so much the rock eating a rock, but things like pharmaceuticals, things like oil and gas industry, things like finance, things like processing visa, all the stuff that can be improved through just hardcore efficiency, you have to assume that it's got a huge future. And that the problem will probably be that we run out of power way before we run out of chips.
Well, yeah, I mean, actually got a couple comments here from some viewers. First is Maganji. He's saying, listening live from Nairobi, Kenya, and enjoying
nice.
Yeah. Also,
I'll tell you a kind of horrible military story if you want about Nairobi, if we have time.
Sure.
So my father was High Commissioner. He was a British diplomat, and he was High Commissioner to Tanzania in the 80s. And so we lived in the governor's house, but next door was the American ambassador, and he had 10 elite Marines at any time around him. We had a guy with a bow and arrow. I'm not kidding. The British ambassador had a guy with a bow and arrow, and it was homemade. So we would always be laughing at the American guys, and all the Marines were my age. I was 17, 18. So I used to hang around with these guys. We had an absolute blast. But one of them showed me the American embassy security, which he wasn't meant to, but it was built originally by the Israelis, and it was on stilts. But you couldn't see that. It looked like a normal building. And the Israelis build those buildings. I'm sure I'm okay talking around military people here, not giving too much away, but it's because if you have a car bomb, it just wipes out the ground floor and there's nothing there. And there were other security devices, such as the famous, spiral staircase that goes up for a right-hander and all these things. And I didn't think a lot about it, but I was mocking him because I'm like, seriously, man, nothing's ever going to happen in Tanzania. Come on, look at us. And we were like the British embassy where you could just walk in by waving at the guy, And that was in the mid 80s, and 20 years pass, and in 1998 or something, I see 2 huge car bombs, one in Nairobi, one in Dar es Salaam. The Nairobi one killed over 200 people. Dar es Salaam deaths, 0. And I'm like, spooky. I know why. Anyway, that's my Nairobi story. Sorry, what was the question?
No, there's another question from a viewer, though, was saying how how do you recommend that vets position themselves in the coming years? I guess you to some degree answered that question already, but
well, I think generally, because I'm not afraid to sort of just go off on one, you have to take climate change very seriously. So you've got to get your life set up in a way that's resilient in terms of how exposed you are to flooding, how good is your power supply, how good is your water. You live in Florida, there's too much water, and the water that they use is near the surface. It gets contaminated easily. You live in Mexico City, there's the biggest bottled water market in the world. There's almost no water supply left now in one of the biggest cities in the world. I live in Brooklyn Heights, not by accident, but I live high. And the New York water system is absolutely one of the best in the world with redundancy. So not only is it brilliant, but it's also got a spare pipe if ever we need it from the Catskills. And the list goes on. So that's the first thing. Generally, as investors, as you age, you want to take more dividend yield. That is, you want more income from your investments. And that's fairly straightforward. As I said, oils are highly cyclical. So if the oil price collapses, you have a problem. But generally speaking, they'll pay you a good yield. And now the companies have set themselves up where if the oil price goes up more than expected, they'll pay you extra. And they've done that for the past couple of years. Utilities wouldn't be a bad place to be for income at all. And I really like the pipeline and the refining stocks for income in the space that I cover. And then if you're a lot younger, if you're saving, having, got out of the military age 25 or something, you obviously then try to tend to buy growth stocks and future stocks, that have less income today, but more promise of being the next Microsoft. And frankly, I don't cover that stuff, but it's pretty hard to do. You can buy something like IWM, which would be the smaller cap index. Russell Growth would be IWC. Russell 3000 Growth would be a good one if you want to long-term invest in lots and lots of small companies, which would kind of be the idea of putting in a lot of money now and, way in the future, coming back to that money. So it really depends on your age and your income requirement. By the way, I just sat like 30 regulatory exams because the continuing education to be a registered analyst, which I don't actually need as an independent analyst, but I do it voluntarily for compliance. And I
outstanding.
had a backlog of 3 years of exams, so I've done a lot of exams these past 2 days.
Well,
anyway, I'm up to date.
What are ways that our viewers can reach you? Like if they want to continue following your work, or they want to, get your perspective on something, what are ways that our viewers could reach you or see your work?
My website is Sankey Research. I get 100 emails a day from guys saying I've searched Google and we can optimize better your search results. If you Google Sankey Research, I'm like the first 3 pages. I don't know what they're going to optimize. On the website, you can see some research. You can actually register for free. And then you can access the research for a while. If you read a lot of it, they're going to come and tell you to pay. Unfortunately, the product is priced for corporations and for institutional investors. So it tends to be unless you've made an absolute insane amount of money, it's probably too expensive. But there is a retail individual. If you're demonstrably an individual, we'll sell you an annual subscription for $1,200. On the spot, if you say you're a vet and you listen to this show, I'll give you a rate because each one is individual to me. It's a 2-person company with a backup management company that does all the logistics, and I can just decide whether or not you deserve a free subscription or not.
Well, Paul, thank you. I'm sure my viewers will take advantage of that. I appreciate your offer.
Sure.
I really want to thank you.
I think my email is on the website. You can find it pretty easily. It's Paul at Sankey Research, by the way, so it's pretty easy. Paul at SankeyResearch.com.
I'll post a link below to that just in case anyone needs it. So, Paul, I just want to say thank you very much for the time you spent with us, kind of going over their energy. We really appreciate it, and I look forward to potentially having you back if you're able to.
Absolutely. It's a pleasure. Thanks a lot.
Thanks, Paul. And to the viewers, thanks for watching. Don't forget to like and subscribe.